This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking with me, Melissa Griffiths.
And me, Steve Dobson.
And we've also got our regular guests, Paul Mattick and Nick Priest. This is the podcast that takes a deeper dive into the alternative marketplace and exploring topical issues. Today's focus is reflections. We're going to look at the past season, 23-24, in the tax efficient space. So who wants to kick off?
So if we look at the tax year as a whole, I think it's definitely been a difficult tax year in the tax efficient space, albeit when you look at the numbers at the end that have been released, not quite as bad as we expected. VCTs, if we look initially, I think in the last podcast, Paul and I both were kind of muting towards around about 750, 800 raised, which would have been down about 25%. In the end, numbers from AIC have actually concluded that there was 882 million raised, which actually is only down 18% from the previous tax year, which I think on the face of it is very, very positive and encouraging for the climate we've been in. Many of the funds, Northern included, that came out with decent sized raises, managed to raise their full money. AIM was popular again. Unicorn raised 20 million in about 8 days. So yeah, I think on the whole it's very, very positive. I don't know whether, Paul, you've got
yeah, very much similar. I was surprised and impressed at how big the market was in the end. It seemed to be, especially the last month, there was 150 million came into the VCT market in March, which that's a big old chunk. And there quite a few of the managers were really closed by that point, but there was some new managers which were raising enough money to be part of the market, which was great. So I think they would see a broader group of VCTs on the market in the future. But there was certainly a bit of a rush towards tax year end, and that's it took us up from, as you say, 750 up to almost 900 million, which yes, it's the third highest ever, and it's a lot higher than the previous kind of era. Before the 21, 22, 22, 23, which was kind of 1 to 1.1 billion. But before that, it was kind of 650, 700 million. But this is quite a big step above that previous norm, I would say. That the era during post-COVID was, there was a lot of money going to VCTs and into global VC. So I think that was, you can see the comparison of VCTs and global VC quite clearly. And we'll talk about that in a minute, but I think it was very encouraging to see the VCT market sustained in 23-24 and at quite a high level, actually, I would say.
Yeah, I mean, something you mentioned, Paul, was this sort of back to normal, but actually it was a bit higher than what we would have. So, I mean, I've got statistics here of...
You like a statistic now,
I do.
don't you?
I love my statistics.
Stato.
I'm always writing them down. 2017, 2018 was 728 million. And then 18-19 was 731 million, which was where I think you were referring to normal before we had the sort of really record fundraising years. So it's actually, it's sort of in between, isn't it? Yep. Which I think for a very difficult geopolitical and economic climate, it's really encouraging across the board.
I think, as Paul mentioned in the last podcast, if you take out the last 2 years, the actual trend following on from the prior years to that is actually still on that trajectory upwards. And actually, that's the encouraging factor, that 882 this year is a really, really good number. We shouldn't overlook the fact, ignore in the 2 years above $1 billion, it's a phenomenal year for VCT.
Yeah.
And I think that actually points to the tax environment we're in. We are in a high tax environment, and having a tax efficient product such as VCTs, and it is, yes, it's kind of a stepping stone into alternatives, but it is quite productized, it's very tax efficient, it's quite easy compared to other products in the market such as EIS, that it's kind of a stepping stone. But I think it's kind of going more and more mainstream, and I think we'll see that as more advisors recommend VCTs to their clients, there will become more and more awareness of it.
And just sort of breaking out the VCTs, obviously we had the Octopus Titan, which was the top fundraiser. We had Northern in there with you successfully did your 60 million. What was the time period on that, Paul?
It was about 6 months. It's our biggest fundraise, to be honest, and we weren't in the market in the busy period at the end of March, middle of March. So Yeah, but there's also British smaller companies and
Yes,
90 million.
90 million, wasn't it? Yeah.
Yeah, so there's a number of 60 million, 90 million.
Albion as well across
Yep.
the five. And I think there was some, great fundraisers. And you mentioned again, we had two new VCTs as well, which was the Protura Growth, and we also had the Fuel Ventures. And I think another thing that did come through was something to reflect on was what was driving demand into the popular VCTs. And I think it has been touched on that it was people that had shown strong exits as well across their portfolio. Would you agree that it does seem to be something that has helped with the bigger fundraised VCTs?
I think there's more scrutiny now in terms of when people are selecting VCTs to go into, looking across the portfolios, because if you look across, you've got very mature VCTs out there and newcomers to the market. So people often look at the VCTs for the dividend yield,
Yes.
and obviously the newer ones aren't at that position they can pay out dividends yet. But when advisors are looking across this 30 odd VCTs available to invest in the marketplace, there's many criteria they will look at, and all those factors will come into play. Exits obviously being one of them, because they want distributions.
Yeah.
I actually would kind of butt in there and actually have a different point.
Ooh.
Oh, sorry. Because VCTs are interesting because it is a lot about yield pay,
Yeah.
and that's not always directly linked to the exits.
No.
So we see some VCTs paying out consistent dividends without big exits behind them, and which is a bit of an interesting dynamic, and how that sustains a different question. But I think fundamentally the VCT is about the yield.
Yeah.
The exits that underlie it, they're kind of they're not clear, because you've got the big pot of a VCT and the cash reserves, and the exits are going back into the VCT, and it's not always directly. Yes, you get specials, and there's a really big one.
That was a good question I was going to ask there, actually. Obviously, historically, there's been some big special dividends paid. I think Octopus Titans had a couple of big ones over the years. What's your view on that going forward? Do you think we're going to continue to see, or start to see, specials come back into the marketplace for the VCTs?
Interesting question. And I think we're in a period where there is a transition still going on from MBOs. So the old asset-backed VCTs, they are still around. We still have some assets which are kind of MBO era, and they were paying out regular dividends to the VCT, and then that was sustaining their dividends paid to the investors. Whereas now it's much more lumpy. So each VCT is relying on selling portfolio companies rather than dividends coming in.
Yeah.
So I would actually expect to probably see not so many specials for the short term, as they kind of get enough cash reserves to be able to pay out the dividends consistently. And so we're getting to the new era of venture capital assets and regularly realising them. We're, whatever we are, 5-8 years in, but it's still, the portfolios are still churning and getting rid of those MBOs, a lot of them. Some of them are straight VC investments, but there are some which have still got some MBO assets. And hopefully that's kind of historic now, but it's still relevant.
I think from observing from the outside of VC, obviously we're not in that market now, and I think post-patient capital review, we saw quite a lot of lumpy special dividends. I think that, to me, Paul, would you think that's just because people were trying to get used to the VCT, was trying to get used to what the post-patient capital review would look like in terms of the underlying investments, where you were seeing some really big exits, and therefore, what do we do with this? Do we give it back to investors? My perspective on that was it wasn't necessarily particularly helpful, because one, it sets expectations for investors, and if you don't have a 10p dividend coming back, then you're disappointed, whereas that's probably twice what you were expecting to get. And two, the idea from a financial advisor's perspective is that they're using this as some sort of future potentially retirement income supplementation, and that actually you don't really want to be earning 2p one year and 10p the next year, because what you want is some sort of consistency of income in retirement. So would you say that you're trying to manage the VCT output in terms of dividends alongside your investors?
I think I would like to see the VCT market deliver on its the yield targets, and in going forward as well, as rather than historically. When there are big exits, yes, of course there should be a special, but I think the attraction of a special is great, but as you said, it is a yield play. You can think about them sitting beside a pension at some points.
We always talk about it as an alternative pension, being able to do a diversified portfolio of VCTs through the Growth Invest platform, and being able to hold them, reinvest after 5 years, and then you sell back into buybacks. You go back in, you get 30% income tax relief, and also you're building up a portfolio. One thing I also think is, it's encouraging, isn't it? Like, as you mentioned, we had post-capital review, the legacy that everybody's had to change and where dividends were coming. And when you see, we had Blackfinch, Springs VCT, we had the Foresight Williams. There's a lot of the new entrant VCTs paying dividends now as well, isn't there? Which is, showing.
The point I just made, they're just starting because their portfolios are starting to get to mature. And as Paul said, the Northern VCTs are 6, 7, 8 years old, is it now?
30.
30.
6, 7, 8 or 30.
Yeah. Rounded. 6, 7, 30.
So.
But the younger ones, they're not expected to pay the dividends. And
No.
as they're starting now, they're joining the more, I guess, mainstream, as you'd call it. And, to the point, people are looking at it as the yield play. And, with the pensions piece, the limitations on how much you can put into your pensions, that's why it's looked upon as a favourable investment vehicle.
Let's move on to EIS. Who wants to
I think that's
round
me
up
again.
the season? Yeah.
Yeah, so I'm happy to talk about that. EIS has had an interesting year, and I would say it's very much parallel to the 2023 global VC venture capital market, which was significantly down, kind of the post-hype years I talked about previously. And I think we'll probably see maybe 200 million into EIS funds. The broader EIS market is a lot bigger than that, which we talked about earlier on.
Yeah.
But the EIS funds, I expect to be around 200 million. The numbers are still to be confirmed, and that is substantially down on the previous couple of years. Again, those were potentially hype years. But I think it was a challenging market, and it is a higher risk than the VCT market, and more liquid. So I think people were probably biding their time. There was, again, a bit of a flurry at the end of the tax year, but we often see that. But it wasn't as substantial as we've previously seen. And I think it is further down the kind of the waterfall. So you do pensions, ISAs, and then VCT and EIS would probably be next in the sequence of tax efficiencies. And but I don't think so much came down into EIS this year, which is fine and is what it is, but it's still substantially higher than the percentage down on the global venture capital, which was very, very blunted in 23 and start of this year. But we are seeing some recovery in global VC, but also in EIS is starting to pick up again. But I think there wasn't any really big offers in EIS, so I think the biggest was probably 35 million, that kind of level, whereas normally, most years you see 50, 60, 70 million from the likes of MMC or Parkwalk, and MMC a couple of years ago was 100 million, whereas having no one over really 35 million just shows even the bigger managers were blunted and substantially down. And this is an open market, so basically the EIS managers raise as much as they can rather than capped out for VCT. And I think the smaller managers in EIS had even bigger challenges in raising, and some really struggled. So I think it was definitely a blunted year. I think probably be kind of maybe 45% down year on year.
Which is quite significant, isn't it, really, compared to the sort of previous years. We also, was it MMC or Parkwalk? One of them didn't come out this year with their knowledge intensive either.
MMC this year,
MMC, yeah. And I mean, that was to do with timescales in deployment, was it? Yeah.
Yeah, and I think similarly the year before it was Parkwalk. So it's an interesting dynamic because we speak to a lot of managers, obviously, as a platform. And, if we look post-COVID, there's a lot of them, well, not a lot of them, but some retracted and focused on their existing cohort of companies because they were seeing valuations as being very stretched, USPE coming into the UK markets. And now I think we're going to get on and talk about the kind of state of the nation in a minute. But it does feel that we have, are we at the low? Who knows? But a lot of the valuations have been marked down substantially. Are we now back to this phase where actually it becomes compelling again? So the opportunity set out there to get into new business investment is back in the marketplace. And whether, Paul, you're seeing that?
Yeah, I think there's always been demand for capital. It's just, you're right about the valuations, and there has been some EIS funds and VC funds overall had a big markdown. And you're seeing like the WeWorks fail, for example. There's some big tech companies which are struggling, and it is quite an interesting global macro at the moment. We can talk about it in a minute. But within EIS specifically, the deployment times are really important, and I don't think many EIS funds are really set up for deployments at scale.
No.
So there's maybe one or two. And part of the reason why MMC went to the market this year, I think they raised 9 million in the end, rather than 100 million 2 years ago and 75 the year before, because they're struggling to deploy it.
Yeah.
So I don't think there's any manager who can deploy 100 million annually, really. maybe we could, don't know, but we're not there yet. So it's one of those situations where there's so much demand for these products that you've almost got to limit how much you take in some years. So otherwise you get this delay of deployment. And the deployment's very relevant for EIS, whereas in VCT you've got a bit of time to play with, but they're also set up for bigger scale deployment within the VCT market, which Titan raises 100, 200 million a year and deploys it quite quickly. Yeah. So I think they are different markets. They are similar in some ways, but they are different.
Actually, and that leads us on to IHT, but that is another thing as well. I mean, we constantly talk about the intergenerational wealth transfer, huge figures that need to that need to be addressed. And with the EIS deployment, obviously, it doesn't start in the underlying investee companies for IHT until the money is deployed by the fund. So that's something obviously that with IHT is going to become more significant, possibly help in terms of creating more use of EIS for IHT.
I've got a question before we move on to IHT, just about EIS for either or both of you guys on the sofa. Just when you think about the Growth Invest platform's target market, which is the advisory market, do you feel like, I know the KI EIS has been around for a few years now, but do you feel like because they've only been around for the last few years, that what we're seeing now is also advisors coming through this period of time where they've done previous types of EIS and finding administratively it quite difficult to deal with, and that's may have slowed down some of the fundraising as well, and now you've had KIs for a few years, that cycle will come around, and maybe because it's a bit easier for them to deal with, that might start to pick up again?
I think I'll let Paul answer this because Mercia have both.
We have both, and I think the large EIS fund managers in the market will launch KI funds every year if they can. They are easier for the advisors, they are easier for investors, and actually they're not much different than the normal EISs. So I think we will see a move to KI. The challenge is, though, is the change. So you had the change from the kind of asset-backed EISs, and then you had the venture EISs, and then you've got KI EISs. I think we've been excluded from some panels because we had a KI and not a non-KI EIS out in the first quarter of this year, which is because they hadn't. The advisors hadn't got it through their minds how to work with the knowledge-intensive EIS.
It comes back to education, doesn't it? And we do see this a lot across the tax-efficient space, I think, where it's, and as you say, that there is so many different regulation changes, different products coming out, that it's hard for people to keep up. And it's not just the advisor has to get to a point of understanding it themselves, but then also explain it to the client, who ultimately is the one who is investing.
Yeah, that was sort of the point really behind it, is because you've gone out to the advisor market and educated them how the tax efficient market works in terms of EIS, how all that works, and then a few years later, actually from an administrative perspective, it can be quite complicated for them, and so then the KI funds come out, but they already have the education's been done, and now it's almost like a re-education, saying, look, the EIS does all the things that you want it to do, and the same sort of thing, but actually, look, there's an easier version of it, and maybe people are just taking a little time to catch up with that.
Well, it might also be why we are seeing a bit more of interest in single EISs, because it is just a simple EIS investment that individuals are making.
Single company, is that?
Single company EISs, yes. And so maybe that is something that managers need to address in terms of, really educating people, because from a risk profile, it's much better to go into the diversified portfolios and have exposure across different sectors, etc. But again, it comes down to the lack of understanding, doesn't it?
Make your doing your tax return in a few years' time quite interesting if you're doing lots of single company EIS.
Well, exactly, yes.
But then if you think about it in a regular evergreen fund, if there's a couple of funds out there that go into multiple companies, we're talking about multiple tens. A regular evergreen EIS, you're going to have a big number of EIS3 certificates to deal with. So it's not that dissimilar. Obviously, you're paying a manager then to risk manage it for you and to select those companies rather than you making those decisions yourself through your advisor. With a KI, obviously, the benefit is the one EIS5 certificate on the close date of the fund. The only unknown is at what point you will get that, because they have up to, is it 24 months in total to deploy. Now, we saw innovation this year with one of the funds. So there's more managers coming out with the knowledge intensive, and their kind of selling point was, well, look, we're going to deploy within 3 months of the close date with a view of getting the EIS5 certificate to the clients within 5 months. because if you're then waiting multiple tax years, it's that administration purpose of it. And I think anything that complicates things is enough for advisors to be put off a little bit by it. So there's definitely simplicity that comes with one certificate, but there's a time and potential issue with it. And I don't know whether you see that and that's fed back to you.
Yeah, well, so we can go down a warren high. There's lots to talk about there, but actually going back to the single companies, 3/4 of the EIS market is in single companies.
Yes.
So let's not forget that. So the EIS funds are part of the EIS market. So say 400 million on average historically, but the actual EIS market is 1.5 to 2 billion a year. So it's quite a big chunk of single companies out there, whether that's friends and family, angels, or family offices, different question. But there is the element of whether you can, financial advisors can recommend single companies, and I'll leave that to you guys rather than anything else. But yeah, KI has complications. In some ways, it's a lot more simple. But it's just different than kind of the evergreen EISs, and that they say it's an educational process, which kind of getting advisors up to speed on an EIS and then a KI EIS. I think it will take a few years, and it's only became mainstream the last kind of year or two. Really, the knowledge-intensive EISs probably should tell what KI means for.
Yeah.
So HMRC knowledge-intensive EIS, but yeah, so it's a fascinating market, but it is significantly down this year, and I do expect the overall EIS market, as well as the EIS funds, to be down this year. We won't actually know how much it's down until I think it's May 25, so kind of very much backward looking, but there we go.
And going forward, anyone's sort of thoughts on this next season, really, because EIS does need a bit of a revival, really, doesn't it? I mean, to me, one of the key things will be to start seeing some exits, which are being talked about through quite a few of the fund providers. But that might get a bit more drive into the sector.
I'm happy to pick up on that. So yes, the exits are starting to happen across the market, and it was great to see Moulton have a big exit with Perkbox recently, and we had a little 3x exit in a company called Glomade, and there was Fido as well, which exited. So these tech exits are starting to happen within the EIS world and broader, and I think that kind of signifies more of a global movement in the VC world, and a bit of an uptick. And once exits happen, cash comes back in. They kind of recycle the capital that's going back to clients quite often. But yeah, so lots of positivity going forward, and I think the next few years we'll see more and more EIS and VCT. I think there is an upward trajectory from where we are now within the venture world.
Yeah. Thank you, as always, to Nick and Paul, and Steve. We'll be back shortly.